Okay, and welcome back. So now this is section 2 of the series of lectures covering time inconsistency in monetary policy. Last time we talked about the Phillips curve for output. I explained how it worked, why it generated an upward sloping aggregate supply curve, which was the result of a signal extraction problem, where essentially what we saw was that deviations in actual inflation from expected inflation could generate increases in output as a result of said signal extraction problem, thereby leading to an upward sloping aggregate supply curve. So now that we've explained how the public works, right, we've explained how the public side of the economy is operating, now it's time to look at how the monetary authority is operating. So if we remember from earlier, we had that Phillips curve for output. So we can really say there's two players in this game. There's the public, which is represented by the Phillips curve for output. Like this. That's player one. Player two is the monetary authority. Now, the monetary authority, before I write down what their objective function is, the monetary authority is bound by what's known as the dual mandate. I've mentioned it before. What the hell? I'll mention it again. The dual mandate essentially states is this thing set by Congress that the Federal Reserve in the United States is tasked with minimizing unemployment and stabilizing inflation. Now, the central bank in the United States and in most countries has what's known as discretion. They have discretion to engage in certain policies dependent on the state of the economy so long as that it is consistent with their dual mandate. Now, there are arguments, or there have been arguments, that the central bank should maybe be bound by some more rules and not have quite as much discretion. So it comes to this debate of rules versus discretion. And we'll kind of see how that works here. Because the monetary authority may try and have the U.S.'s best interests at heart when they're trying to engage in monetary policy to increase output above its natural rate. They're trying to do a good thing. However, they can end up causing more harm than good under certain scenarios. So, what's going to be happening here is this central bank, the monetary authority, is going to have a utility function that's consistent with the dual mandate. Now, the dual mandate in the United States is to minimize unemployment and stabilize inflation at a target inflation rate of about 2% set by the Federal Reserve. Now, here, instead of looking at unemployment, we're going to be looking at output or production. But the two are pretty similar because if you need to increase production, well, what do you have to do? You have to hire more people, therefore, unemployment goes down. So we'll be seeing that the utility function is consistent with the dual mandate that's set, only it's just in terms of output rather than inflation. So what is their utility function? Well, their utility function at each point in time t is equal to this parameter lambda times deviations in actual output from the natural rate of output minus 1/2 times inflation squared. Right, so we know yt is the actual rate of output. Yn is the natural rate of output, and it's what output would be if everything was just left the hell alone. lambda is essentially how much the central bank cares about deviations of output from its natural rate relative to inflation. If lambda is high, that means they care more about output than they do inflation. If lambda is low, they care more about inflation than they do output. So if lambda is high and they care more about output than they care about inflation, or trying to stabilize inflation, this is what's known as an inflation dove. They are dovish when it comes to policies regarding inflation. Right? If you want an example of an inflation dove, we can look at, well, Jerome Powell. He seems to be a little bit dovish on inflation. An excellent example of an inflation dove was Janet Yellen. She was the chairperson of the Fed before Jerome Powell, who is currently the Fed chairperson. Janet Yellen was known to be extremely dovish on inflation. Ben Bernanke was kind of a weird mix because he came in relatively hawkish, but he understood there was a trade-off between output and inflation, or unemployment and inflation, whichever one you care to think about. We'll say output here, and just context of the model. But there are also more hawkish central bankers, right? What makes someone a hawk? Well, if lambda is low, well, they care more about stabilizing inflation than output. This makes you rather hawkish on inflation. Paul Volcker, chairman of the Fed in the beginning of Ronald Reagan's administration, came in right after stagflation in the 1970s, saw what was going on, and took some pretty particularly harsh actions, namely massively cut the growth rate in the money supply, cut inflation, triggered a recession, but ultimately stabilized output and inflation in the long run, and everything that's followed has since been known as the Great Moderation. Now, that would be a particularly hawkish policy on inflation because he cared more about trying to stabilize inflation. He was very strict on trying to stabilize inflation, hence the term hawk. So lambda really determines whether we are hawkish or dovish on inflation. So let's talk about the rest of the stuff. Well, pi t is still just inflation. So what's going on here? Well, if you look at this utility function, right, let's look at what is positive, what's increasing utility here, and then let's look at what's decreasing utility. This lambda times yt minus yn will increase utility if yt, the actual observed rate of output, exceeds that of the natural rate. Therefore, the central bank has every incentive in the world to try to boost output above its natural rate because, well, it'll increase their utility. So while increases in output above the natural rate increases the utility of the monetary authority, increases in inflation will decrease utility. How do I know that? Well, if we look at the objective function for the monetary authority, we can see that inflation is negative there. It's minus 1/2 pi t squared. So output will increase. An increase in output increases utility. However, an increase in inflation will decrease utility. So long as inflation is positive, it will be decreasing utility. So if there is an increase in inflation, it can reduce the utility of the monetary authority. So now this is probably where you're going, okay, why would there be any inflation whatsoever? Well, allow me to learn you something. Yes, it does decrease utility. However, if a little bit of an increase in inflation leads to a bigger increase in a deviation of output from its natural rate, then the central bank's overall utility will be increased. So if we increase inflation a little bit, but we get a larger response in output, then the monetary authority's utility function is higher. They do better. All right, so as long as we just increase inflation just a little bit, but we can increase output by even more, then sure, it's kind of a cost-benefit analysis here. There's a trade-off between output and inflation. That trade-off is that if you want a little bit more output, you're going to have to deal with a little bit more inflation. But so long as the amount you're increasing inflation by doesn't exceed the amount that you're increasing output by, then everything is good. So it's a balancing act, right? How much are they going to want to increase inflation? How much inflation is a central bank going to be willing to tolerate in order to increase output above its natural rate? So let's write that out. So the question really becomes, how much inflation is a central bank willing to tolerate to increase output above its natural rate of output? Well, guess we're going to have to figure out a way to answer that question. Because if we've got two players, we've got the public and the monetary authority. The monetary authority is going to figure out how much inflation there's going to be. They're going to announce certain policies of inflation, and then ultimately decide how much inflation there's actually going to be. And if there's any deviation from that, if there's any deviation from what they announce, which guides expected inflation, if there's any deviation in that from what actual inflation is, then if inflation is higher than what they announce, they can increase output, at least just in the short run, just a little bit. So then it really just becomes, okay, well, if they're going to do that, by how much are they going to do that? That's really the big question here. So let's look at the timestamp real quick, see how far in this video we are. 16 minutes. Okay, so we're about 16 minutes in, and I think I'm actually going to leave it here. So I'm going to drop this stuff for the lecture now. We are going to, in the next video, answer this question, and we're going to analyze exactly how this whole thing is going to work. We're going to talk about how the central bank is going to announce a certain rate of inflation to guide public expectations, and then how the central bank is going to actually engage in monetary policy to drive inflation in hopes of driving output, and when and where there may be certain times that they'll deviate from what they announce. That is coming up in the next lecture, so stay tuned. Thanks for watching.